Winter is fading, so too perhaps are currency wars. The world of FX is agog at the idea that last month's G20 meeting in Shanghai agreed a pact to stop central banks undercutting each other with ever-decreasing currencies. Now, whether or not that is true, the arrival of spring may bring with it the return of the carry trade, that familiar FX strategy in which investors borrow money from low interest rate countries and buy assets where rates are a lot higher. Now, that may seem far-fetched, considering that just a few short weeks ago the market was in a frenzy and investors weren't interested in investing in anything. Conditions for carry trading look surprisingly favourable. Volatility is low, funding currencies are more stable, and interest rate differentials are relatively attractive. Take a look at this chart to explain why. Over the last 12 years or so, courtesy of our friends at Deutsche Bank, we see their carry trade index does extremely well when volatility is low, as you can see in 2007 and again towards the back end of 2012. Now, for today, is this too good to be true? Quite possibly. The scars of 2015, which left carry trade investors nursing big losses from China's sharp renminbi depreciation in August, are healing all too slowly. And yes, a rally in emerging market FX, where the search for yield is most likely to be found, was well underway at the beginning of the month, but appeared to have faded just a week ago. Then came last week's surprising policy meeting by the Fed. Not only did Chair Janet Yellen send dollar bulls into apoplexy, she set out the central bank's dovish stall for the next few months, declaring how worried they all are about an environment of low inflation. Meanwhile, the arguments against investing in EM are reducing. Inflation in some key markets has been kept at bay, current account deficits are shrinking, FX falls have levelled off and even reversed. A weaker dollar is at the very least starting to force banks to review their bearish EM calls. Investors may prefer to see a few more daffodils in the ground before committing to EM and the carry trade. Brazilian politics, for example, such a key factor in EM confidence, makes the market particularly queasy. So does any deep scrutiny of China, while questions about oil's rebound just won't go away. The problem is, by the time investors summon up the courage to dip into the carry trade, will it all be too late? Strong US data may see the Fed hike sooner than expected, creating a rush for dollars. Already, the usual Fed suspects have begun sounding a lot more hawkish than the position agreed by the Fed last week. The carry trade may be back, but it probably won't be around for long. A short spring of mild temperatures may soon yield to a very hot and sticky summer.